Um, Welcome to another session of agent training. Today we are talking with Tom Long and Associates. We are learning about taxes. Before we jump in there, I wanted to let you know of two things. Number one, we actually have an in-person event tonight. We rented out a movie theater. There are 20 tickets, but only one ticket left to go see Groundhog Day on Groundhog Day, because today is Groundhog Day, if you didn't know. So yeah, we will be doing that. We'll be masked up the whole time. Bonus that I think most people don't know about, this meeting has, Groundhog Day has been sponsored, and our sponsor has generously given us a crap ton of money for concessions. So if you come, you can load up on those M&Ms and popcorn. So everyone go get that one last ticket that's left. We would love to see you there. Secondly, tomorrow's training, I'll say this again at the end, but I just want to remind you that tomorrow's training is about inspection responses. It's being led by the amazing Megan Sullivan. If I hear something the most from you agents, it's that inspection responses are the worst part of your job. So come learn how to be an expert about it. Megan is specifically excited to tell you all the things that she never wants to see on an inspection responses for new agents. So it's going to make you smarter. Hope you can come. But without further ado, we're going to learn about taxes today. So Tom, thank you for being here with us. It's always a delight to have you. We learn a lot whenever you're here. So thank you. Can you start by telling us a bit about yourself, which I know feels like the most classic interview question, but can you tell us who you are, where you live, when you started your business? Give us the brief life history.
So I was Chicago born and bred, got down to Indianapolis through Butler University. It's where I graduated, met my spouse. She's younger than me, so I got stuck here. I opened my company in 1996. So been a long time, 25-year tax season right here. We have grown from me out of my house to now there is 12 of us full-time, 22 of us in tax season. We do a little bit of everything big boys do, planning, strategy, tax savings, business consulting, bookkeeping, payroll. We try to be very proactive for you guys, because in the end, it's not what you make, it's what you keep. And how we structure things, how we deduct things makes a big difference in that. We like to, as I say, get involved as much or little as you need. So some of clients, we do everything. We literally pay their bills. Other clients we see once a year, tax time. And then there's everything in between. Ideally it's quarterly or semi-annually, trying to figure out so there's no surprises.
Yeah, that's great. Tom, where do you live in Indy?
I am up here in Fishers, Indiana, 116th Street. So Indy, I've found, is a much smaller place and community than I realized. You kind of get to know everybody after a while. It's quite surprising when I come across other CPAs and I've already known them and they live in Avon, Martinsville, Greenwood. I mean, it's amazing.
It's a small world. Tom, last time we had you here, I remember you sharing about your son and that he was becoming a CPA, and you were like, you're not going to learn all the mistakes at my company. You're going to go somewhere else and learn them. Is that still the case? So what is the update with your son?
I have two sons. They both will not work here out of college because I want them to learn how to work away from me, because I may not be able to yell at them as I probably should. So I got a sophomore and a junior, and it's going well. They do work here during tax season. My junior is at IU, who's all virtual. So he's actually coming up tax season. He's living at home again. So we're not empty nesting yet. And he's staying with us because it's free food and comes in and works during the day. So.
Oh, that's awesome. Tom, what is actual tax season? Like, from when to when is tax season?
So the government kind of makes you file by certain dates. So for businesses, it's March 15th. For personal, it's April 15th. And so we compress all up, probably about 65% of our work in those first 3.5 months of the year. So from January 1 to April 15th, I make my staff work 60 hours a week. Summers, they get to work 28 hours a week. So in Indiana, that's not a bad thing. You know, when weather's like this, not my beach, but when weather's crappy like this week, it's okay to work so much. So
yeah. What do you guys do when it's not tax season?
a lot of consulting, a lot of helping people with organize, bookkeeping, seminars, lots of just trying to help people understand.
Yeah, that's so good. Well, thanks for coming to talk to us during tax season. Much appreciated. Okay, so taxes, as we know, get complicated for everyone, but definitely for real estate agents. Can you talk about high level? We'll get deeper into all of this, but high level, what do agents need to know about their taxes?
So the big thing, most of you become 1099 contractors. So all of you are your own business. What does that mean? Well, it means there's no taxes paid on the commissions you get. So now you have to track all your expenses that you spend. And that's the good thing and the bad thing. The good thing is that you get to write off what you incur for your work. And so you document. So where the IRS wins is when you don't document well. So they want to see what I call the 5 W's: who, what, where, when, why. So let's think of a meal receipt. Every one of you goes out with your friends, right? And you go eat a meal. Well, used to. So what's on that receipt? You have the what, you have the where, and you have the when. It's printed right there. So now you need the who are you with, and the why. Potential customer, potential referral source, all those are legitimate business reasons. So if you're eating meals with anyone but just your family, it's probably deductible. So that's an easy one. Mileage is another one. You guys, the biggest deduction realtors tend to have is mileage. Well, how do you document your mileage? Well, there's apps out there that will do that, whether it's Mile IQ or some others. You really want to track your miles. Where the IRS wins is you go, I claimed my car and I drove 14,000 miles. And they go, show me your mileage log. And you don't have anything. So they want to know who you went to see, why you went to see them, where. So Mile IQ is just a thing you hit start, stop on your phone, and it tracks it for you. So like I said, a lot of things can be deductible. Gifts, closing gifts, your E&O insurance, your membership dues, MyBoard dues, your broker fees, all those things reduce what you pay on taxes. So that's where I go back to said before, it's not what you make, it's what you keep. So we want to throw as many things into that bucket as we can. So a lot of my summer projects are clients asking me, hey, I'm spending a lot of money in this area. Can I make it deductible? The answer is usually yes. But the second part of the answer is usually with documentation. So, that's the one thing. And then the second thing, after being self-employed, is since now you must pay your taxes quarterly. So people don't understand is you don't want to like go the whole year without paying a tax, because then at the end, the IRS charges a penalty for doing that. So there's what they call quarterly estimated taxes that you would pay. And if you make enough, we'll talk about, should you be a different type of entity? Should you be an S Corp or something like that?
Tom, so it sounds like tracking mileage is pretty easy there's tons of apps you can use. For other kinds of tracking, do you have anything that you recommend or something that makes it easier on you guys? Is it QuickBooks? Is it receipts in a shoebox?
Shoebox, not good, but better than nothing. There's an app called Expensify. So let's say you go out and you buy something. Expensify allows you to take a picture of that thermal receipt you get, and that will then store on your computer. You could then categorize it as to what it is. Obviously, if you have QuickBooks or some sort of tracking system, Excel spreadsheet to document your expenses, that's good too. In the end, what your CPA or accountant will need is just the totals. We don't need to see every receipt. In the end, if the IRS audits you, that's when you need the receipt. And they do ask for the receipt. They don't let you just go off your debit card activity or what's on your credit card. They want to see the actual receipt.
Yeah, that's great. Agents, I forgot to mention, if you have questions, feel free to drop them in the chat and I'll make sure to ask them. Or at the end, we'll leave some time that you can unmute yourself and ask. Tom, tell us more about quarterly taxes. How do you figure out how much to pay? How do you know if you should, pay through an S corp?
A lot of people ask me, okay, I'm now self-employed. What should I set aside for taxes? General rule of thumb is about 40% of your net profit. Net is defined as what you get in commissions less all those expenses you incurred. So you should be tracking your expenses as you go, but it should be about 40% of net, because not only do you owe income tax, you owe Social Security and Medicare, called self-employment tax. So that's the big surprise. That's another 15.3%. And that's why I said, if you're consistently profitable, say you're above 50 to 60,000 a year profit, there's some accounting reasons, tax reasons, you make yourself an S corp. You can avoid some of that Social Security and Medicare. There's more paperwork involved, so that's the cost of doing that, but you save Social Security and Medicare. And then the quarterly taxes, the IRS defines it as quarterly taxes, but it's not. It's due April 15th, June 15th, September, then January 15th. So it's like those 4 months or 3 months, 2 months, 3 months, 4 months. I don't know why they did that. They just did that. And so what we tell people is keep track, estimate. It's better to pay in something, but let's go to the worst case scenario. Worst case is you paid nothing all year. At the end of the year, you owe this amount, 40% of your net. Uncle Sam is going to charge you what they call an underpayment penalty. People hear the words IRS and penalty and they kind of freak out, right? What it really is an interest charge for not paying your taxes. And right now, that interest rate is about 4%. So it's not even a bad rate. So I have some clients, they refuse to pay estimates because they could have a huge first quarter. And if they calculated 40% of that, that's a lot of money, but they have minimal second quarter. They don't know what they're going to do second quarter, third quarter. So they kind of just pay what they can and then make it up at the end. And that's okay. Because the worst case scenario is you're paying an interest rate, which is less than credit card rate, less than probably your home equity rate. So it's not a bad interest rate. State of Indiana is a little higher. I would definitely pay the state. They have not only an interest rate, but a 10% penalty. So it ends up being about 16% to them. So.
Tom, this may feel like a dumb question, but as a W-2 employee, my taxes just get pulled right out of my paycheck. How do people actually, who do they pay the taxes to? Are they sending the money to you? Are they sending, where does that go? How do you do it?
Oh, there's online. You actually pay the IRS and the state directly. You could pay online, or you could send in a paper check with a form called 1040-ES for estimate. I recommend online. It's easier. You have paper tracking or documentation, and I could send you the link, Rosie, at the end of this, so that you can then pass out to everybody the links for the online setup.
Yeah, that would be great. We just had a great question from Natanya come in. She said, can you talk about healthcare, write-offs, etc.? Yep.
So by being self-employed, you are allowed to write off your self-employed health insurance. So any premiums you pay with after-tax money, so not through your spouse's plan, it is deductible. So people ask me, this gets to the strategy part of things. So there's types, let's say you have a health plan. You have one that's low premium, but it has a high deductible, or you have a high premium, low deductible plan. For business owners, it's actually better to have the second plan because the premium is deductible. As an expense you can write off, the deductibles are not. So it's a strategy game, and that's where we kind of help out with you guys, trying to figure out which is best. Your accountant, your financial advisors, they should be able to guide you when you just ask questions. Why one thing, we don't charge phone calls, emails. We want you to ask us questions. Your advisor should want that because the more they know about you, the more they're going to be able to help you. And so healthcare is a big deduction for you when you're self-employed. Other deductions that tend to be pretty big, like I said, was mileage is usually number one. Referral fees. You guys pay referral fees to each other and you share and you pay inspection costs or whatever. All those are deductible too. So if you think about it, your mindset's got to change, not to be crass about it, but it's to be, could it be deductible? I'm going to Sam's Club. Am I buying something at Sam's Club? Could that be deductible? The answer is probably yes. And so you want to change your mindset to write off as much as you can.
That's great. Tom, we had another good question come in from Eliza. She said, if you're making under a certain amount, are you still required to pay quarterly?
It's based off of, so I'm going to get a little technical, and when I see your eyes glaze over, I'll shut up. But it's your underpayment penalty to avoid it is you have to pay in either 100% of last year's tax or 90% of the current year tax. So as long as you have some other withholding that's paying in 90% of your tax, you don't have to make estimates. But if you don't, let's say this is your only job and it's all self-employment, it then comes into fact you have other deductions. Every one of you on the screen is different. Number of kids, does your spouse work? Do you have a spouse? Do you have another second job? All those things come in. So all your taxes is one big bucket. And so it depends on your bucket, whether or not you have to make those estimated payments.
Yeah, that's great. What kind of things do realtors need to keep in case of an audit?
So I kind of alluded to it earlier. You need receipts, and minimum, you want to keep them for 4 years. Okay. People ask me, I've got my tax return from 1990. Well, good for you, shred it. So general rules of thumb, anything beyond 4 years, you can shred. The IRS can go back and audit you for 4 years, 3 years plus the current year. So we're in 2021 today. They can audit you for 2020, 2019, and 2018. So they say, I want to see your meal receipt from 2018 and you don't have it. Guess what they can do? Oh, that's not deductible. So keep those things for 3 years. That's why Expensify is also good. It is a lot cheaper to have computer storage than it is to have basement storage or storage facilities. So store those things as long as you can. What I also like to tell people in the audit, besides the receipts and mileage logs, just think of documentation. So picture my background is Aruba. I was able to write off my Aruba trip. How'd you do that? I documented. When I was down there, I looked at a CPA firm I was going to buy. Was I really going to buy him? No. But I was able to spend some time with him. I got a file that's about that thick of information from him. You guys go to California. Can you write off your trip to California? Maybe. It's how you document. What did you do there? Did you look at real estate? Did you grab a realtor's card? Did you go look at an open house? Did you want to see how things were decorated? Lots of business reasons why you can go travel. So documentation is key. In the end, the more documentation you have, the better, because an agent can't call you a liar. He can't say, why were you in California? I have a stack that thick. I got open houses. And he goes, oh, okay. Now, if he says, why are you in California? You say, I went on a business trip. You go, show me some documentation. You have none. Guess what he's going to do? So keep the files as much as you can. More is always better.
That's so good, Tom.
So let me clear another thing. On an audit, let's just say random, you have a 3% chance of being audited. That's how many people on average get audited. By having a business, you automatically double that chance. You automatically go up to 6%. Then they start looking at your flags. And people say, well, what's an IRS flag? A flag could be too much deduction in one area. Something doesn't look right. So I had a client, similar industry, not real estate, but a service industry, had about 40,000 of revenue. He claimed about 50,000 of meals and entertainment. That's a flag. So, we look at your numbers and we're gonna say, no, that looks a little too much. Are you sure you can justify that? You may be able to, and it may be legit. So don't be afraid about it if you have the documentation, but we'll identify the flags for you. I had a client, he claimed 82,000 miles driven in a year. He actually did. He had a mileage log that supported it, but that was a flag. That's basically you're living in your car. So you want to identify the flags and make sure those are the areas you have documentation. So when you get audited, people hear of the IRS agent coming to your house, and that's what they call a line item audit. That's pretty rare, actually. Most audits, you don't even know they're doing. It's something on your return, it flagged them, they pull it, causes a person to look at it, and then they might send you a letter or question, please justify your meals and entertainment. So then they ask you for just your meals and entertainment receipts. They don't ask for anything else. So there's different audits. And then the worst one is what I call a lifestyle audit. A lifestyle audit is you claim you make 20, 30 grand a year. Okay. I'm going to give you a real life example. I had a heating air conditioning guy come to my office, and we're going through taxes and what you can write off and license plates. You can write off your license plate. He goes, oh, it's in my car in the parking lot. At the end of the meeting, we go out there. He's driving a $180,000 Lotus. And I'm sitting there going, you're an idiot. He's like, what? I paid cash. I said, you've been claiming 20, 30,000 a year. You're driving a $180,000 Lotus, and it's not something you could haul air conditioners in. And so sure enough, a year and a half later, he got audited. It's a lifestyle. They look at how they know that's what he had. Normally people take their cash and they buy assets, house, cars, trips, stuff that could be tracked. So that's what they do. Literally, I don't know if you know this, but all the trash services in the country have an arrangement with the IRS, where if they tell you to go pull your trash, all these trucks have a compartment where they put your trash and it doesn't get scrunched, and they save it, goes back to the raised trash service, and they let the IRS agent sort through it. So they will do that for a couple months prior to an audit.
Tom, I feel like you just let us in on a conspiracy theory, but it's like it's a real conspiracy.
I've worked with the criminal investigative division of the IRS on some cases, and that's how they tell me they get their info. They pull your trash. That's why you should shred. Anything personal document, you shred it, or you stick it in with the baby diapers. Make it painful for them. So.
Oh, wow. That's amazing. Thanks, Tom. Okay, you touched on this a little bit, but can you say more about the difference between an LLC, S Corp? We encourage all of our agents to have all of their business stuff under an LLC. Can you talk more about that?
So first of all, a biggest misconception out there is an LLC is actually a legal form of entity. An LLC can actually be anything. It could be a sole proprietorship, a partnership, an S Corp, or a C Corp. So when people tell me I'm an LLC, that tells me nothing. That just says you're a business. I need to know your tax form of entity. So an LLC is a type of legal entity. An S Corp is a tax form, different from sole proprietorship, which most of you probably are in it right now. But an S Corp is a separate company. It files its own tax return. You're required to pay yourself payroll, like a wage. So for those that want to qualify for financing, it's better to have a paycheck from your S Corp than to have commissions from a sole proprietor. Banks typically don't like self-employed businesses for at least 2 years. It's hard to get refinancing, hard to get loans. Whereas you have an S Corp, you can see, here's my paycheck. So there's a cost to doing S Corp. It's about $200 to $2,500 a year to be an S Corp. but there's tax savings. You save Social Security and Medicare by doing that. And normally when I'm down there in person, I'll draw it on your whiteboard, a chart, right? But basically, let's just say you make 100 grand, because I like round numbers and it's early morning. As self-employed, you pay income tax on 100 grand, plus you owe 15,300 self-employment tax, 15.3%. Okay. So leave the income tax part out. We're only going to talk about self-employment tax. Now you're an S Corp. In S Corp, you make 100 grand. You have to pay yourself some wages, usually about less than half. Let's say you pay yourselves 40,000 in wages. That leaves 60,000 you take out of the company as a draw. That 60,000 as a draw, you do not pay Social Security and Medicare. So 60,000 times 15.3%, you're saving about $9,000 in taxes a year just by being an S Corp. But you're going to pay $2,000 to $2,500 of tax return, payroll, other crap that you have to do. So net, you save about $6 grand, $6,500. Where that break-even point is like I said before, right around that 50 to 60,000 net. That's the break-even level. If you're below that or consistently below that, you're better off self-employed. If you're above that, you're better off to be an S Corp.
Great.
The other question I get a lot is vehicles. So vehicles, do I get to write off my mileage or do I get to write off my cost? Your car payment, your gas, your plates, your oil. The answer is you get the greater of the two. So you have to track both. General rules of thumb are, if you're 12,000 miles or more, you're always going to be better off taking mileage. If you're 10,000 miles or less, you're usually better off taking actual. If you're in between that range, it depends on your car. Is it a gas guzzler? Does it need repairs? That kind of stuff. That's the other question I get a lot is cars. Sorry, jumped in there.
No, that was perfect. Tom, some agents have people that they employ, like an assistant. How does that all work?
So it's not supposed to be pick or choose. Okay. The IRS has what they call 20-factor test to determine if they're an employee or a contractor. Basically boils down to three main points. Who controls the job? Who provides the materials? Who can lose money? So think of Rosie. I'll pick on you. Okay. Rosie shows up. She gets paid an hourly wage. They give her the computer. They give her access. They tell her when to work, how to work, use her supply. She's an employee, right? Think of you guys as realtors. You guys go sell on your own. You work on your own schedule. You use your own materials. You're a contractor. So and you can lose money as a contractor because if you don't sell, you still got to pay your E&O insurance, still got to pay your MIBOR dues, you still got to pay. So who can lose money? That's usually the biggest indicator. Either case, you want it in writing. Get an employment agreement or a contractor agreement with that person so that they both know, because then you're less likely going to have someone later on say, hey, I should have been an employee all these years, but you paid me as a contractor. Now go back and pay my Social Security taxes. So it's really not a pick or choose. There are things you can do to sway it one way or the other. And that's where we help out. What are those factors? What do we need to do?
And then if an agent didn't want to run payroll for their employee, that's something that you guys do, right?
Yeah, so you can do it with us. QuickBooks has it. There's companies called like ADP or Paychex. It depends on what you're looking for. If it's a single person, just you, accounting firms can usually do it as well and cheaper. Think of it this way. Payroll, they charge you per check. So if you're taking out weekly paychecks, you're paying a lot more than if you're taking out semi-monthly paychecks. So you want to kind of space it out. You can't go monthly unless you're in a professional field. So if you hire a receptionist or someone to help you with marketing, they've got to be paid at least semi-monthly.
That's great. Tom, can you talk about the difference between CPAs and financial advisors. Why would someone need a financial advisor in addition to you guys?
I tell people all the time, you need to have 5 resources on speed dial. It's your accountant, your attorney, your insurance agent, financial advisor, and maybe a personal banker. Okay. Those 5 you need to all have working together. In the end, we're out to do one thing, and that is to protect, grow, preserve your wealth. If you think about what does an insurance agent do? Insurance agent protects your wealth, right? What's an attorney do? He preserves it from legal action. He preserves it in terms of estate taxes. What's your accountant do? He helps you grow it. He helps you keep it. You know, what's your financial advisor? Guy that takes care of your 401ks, your investment accounts. What do those guys do? They're trying to grow and protect as well. Those 5 need to be working together, because there's things I can say or do, or things that an investment advisor does. Let's pick on him, for instance. He sells and creates all these capital gains of your stocks or takes money out of your retirement. Well, that causes a tax issue for you. Well, your tax person should know that. So it's working together. So your financial advisor is typically the one on the investment side, retirement side. You know, accountants and attorneys tend to be the ones that end up being the quarterbacks. They keep the 5 together and they make sure we work together. Attorneys just charge a lot more.
Tom, I'm about to ask you a question I didn't prepare you for at all. That's kind of murky waters. But I would love to hear you talk a little bit about tax strategy. We just had a financial series a little earlier in the year where Mark, our managing broker, or sorry, not our managing broker, our principal broker, kind of walked us through some different tax strategy for agents. Can you talk about what that means to you?
So in what context? So there's a lot of different contexts you can take that.
We were talking about it in terms of rental properties, but I would love to hear you expand more on that.
So rental properties in general tend to be a very good tax strategy, because in the Midwest especially, they tend to create a loss for taxes, but they're either positive or break even for cash flow. So, and why is it a loss? It's because you get to depreciate that rental property over time. So I had 48 rentals at one time. I've also flipped homes. We were flipping 5 to 6 homes a year, and there's pros and cons to all of it. Rentals can be different from commercial to residential to farmland. So yes, what it allows you to do by buying a rental, one, gives you more things you can deduct. So as a realtor, it may be hard to deduct a circular saw or a ladder or some other things like that. When you have a rental, now those things can be deducted. So it also helps you grow your assets. So what does rentals do? Someone else basically pays your equity. That's the whole point, right? So they tend to be ways to, if you're okay with the management of it, and there are management companies that charge you a fee to do it, but then you're not making as much. But if you're okay with that, it's a cash flow generator. You can either break even and someone pays your mortgage and you're building equity, or it's giving you some cash. Now, I've got clients have properties in Florida, East Coast, West Coast. Those tend to lose cash, and they hope the appreciation in value more than offsets it for when they sell. So you got to be a little different investor to go do those type of homes, because you got to have the cash to go pay for that shortage. I always tell people to figure out best case scenario of what you're going to collect, less what you're going to have to pay in mortgage and stuff, and then put a vacancy factor of 15%. If you can afford that negative, in case it's vacant for a while, that's when you make sense. It does to be an investor, because it's always going to be some point vacant.
Yeah, that's great. Any other tax strategy things that you would share?
So with real estate, one of the best things that's a tool in your pocket, and maybe you have buyers that do this, it's called a like-kind exchange, or a Section 1031. It's where you can swap a property for a property and basically pay no tax. I've had a farmer client. He's done it 4 times now. He started out with maybe 100 acres, sold it, bought 500 acres, sold it, bought 1,000 acres. He's now up to 6,200 acres, and he's never paid a dime in tax just by swapping land for land. You could do that with homes too. It's the only thing you could still do in the IRS code that you could swap and not pay tax.
That's great. Demetria just had a question. She said, can the money we pay for rent/mortgage be deducted if we use a room in our house as an office?
So home office. So years ago, I'm going to date myself, 10 years ago, that used to be a red flag. Okay. Think about what's happened in the last 10 years. Pretty much everybody has a home office. Think of what's happened in the past year with COVID, right? There are so many people working at home that didn't used to. So it's no longer a red flag. So with the home office, you get to either claim with no documentation, $5 a square foot. So if your home office is 10 by 10, that's 100 square feet times $5, you get a $500 deduction. Or you could track it all and then you get a percent. So let's say your house is 2,000 or your apartment's 2,000 square feet, you're using 200 square feet, so you get 10%. You would then get 10% of everything related to your house. Utilities, homeowners insurance, homeowners dues, mortgage, real estate taxes, all that. But you got to track it. Tracking it will always get you a bigger dollar amount, but it does take a lot of tracking. You have to have pretty good systems to do that, because they're going to want to know your 12-month gas bill, 12 months of water bill, 12 months of sewage bill. I mean, they're going to want you to track all that. So, but yes, you do get to write off your home office. It has to be exclusive. So people go, well, I'm using my dining room as my office. Well, that doesn't count. If you eat there, that's also used for private. You can't write that off. So what I tell people is make a place in your house, barricade it, wall it off, whatever, that is your office. And then that's your space. Can't be shared bedroom. It can't be, some people have a second bedroom. Well, if they don't use the second bedroom because no one ever visits them as a guest, well, that becomes an office. You just happen to have a bed in there. So let's be real. How's the IRS going to know a second bedroom was ever used? They're not. So it's all a matter of documentation again. And that also triggers another thing. You have a home office. Let's say you put a 57-inch TV in that home office. That TV is now deductible. So you want to track and kindly, sometimes maybe you might take a picture of your office that shows that the TV was actually in there. There's your proof. IRS agent goes, hey, I see you bought a TV. Yeah, I bought it for my office. Here's a picture of it. So documentation once again.
That's great. Tom, when you're working with real estate agents, what are the things you look for that make you go like, oh, yes, you guys are making my job so easy. I love to work with you. How can we get to the point where you love to work with us?
It's in the organization. So it's what you give us. Like we said earlier, a shoebox full of receipts is bad, but that's better than when you come in and say, I have no idea what I spent my money on. Better is, Excel spreadsheet. Best would be Quicken or QuickBooks, where you just hit a print button and it has all your income and expenses summarized. So those are what I view as the levels of categorization. So the more organized you are, the easier it is for us.
Okay. And then Tom, I have one last question from me, and then we're going to open it up to everyone else. My last question is purely personal, so sorry to everyone else on the call, but I have Tom to myself at the moment. Do you have a financial advisor that you would recommend?
I use a couple, and the thing is you, more than anything, your advisors, your insurance agent, accountant, investment advisor, they have to be a personality fit. There are a lot of good and bad ones of each, and in the end, you have to be able to talk to them and be able to communicate. That's why I said I usually give out 2 or 3, because then I want you to find your personality fit. And I recommend you guys do the same. If you guys hear someone, hey, I need an accountant, give out 2 or 3. Hopefully I'm one. Let them find the personality fit. Because if you're not comfortable asking them questions, they're not going to be able to help you the best ability they can. And so you have to have that open dialogue, open relationship. I'm a night owl, so I do emails till 2, 3 in the morning. Not many clients like me calling them then. So I love people sending me emails and I respond that way. 9 o'clock this morning, this is the earliest you ever see me up. So I haven't had my coffee yet. I'm not bouncing quite yet. So
Tom, I had no idea. Thanks for making the sacrifice.
I was literally walking in the office with about 8:59 ready to go hit start. So.
Oh, I love that. Yeah, that's so good. Do you have specific names of financial advisors that you would recommend, or would you just say
I will
Google?
I'll send you a couple because it depends on what you're looking for.
Sounds perfect.
So some people are really good at growth trading. They know what to buy, when to buy, kind of thing, but they're not really strategy in terms of budgets and cash flow and that kind of stuff. Then other financial advisors tend to be more big picture. They'll put you into funds and that kind of stuff, but yet they're really more involved with your whole structure. So it depends on how much you want to do versus how much you want them to do. And that's why I said you got to hear from them, but I'll send you a couple and then you can send it out to the team.
That's perfect. Thanks, Tom. All right, to the rest of the people on this call, what tax questions do you have? You have Tom's undivided attention.
Oh, I like that. Easy questions. Or did I put you all asleep?
I know, I'm going to let the awkward silence go on for about a minute. And then we'll let it go.
Natanya has one, I think.
Natanya, go for it.
Hi there. Can you talk a little bit about IRAs, Roth, and healthcare spending accounts?
So 2 topics. You've got retirement plans and you got health plans. So as a self-employed, you could either fund an IRA, which is $6,500 max per year, or you can fund what they call a SEP IRA, SEP, and you could fund basically, based on the math you do, it's about 20% of your net profit. So then there's a third option called a solo K. It's like a 401k for the individual. You could fund 19.5 as deferral plus 25% of your profit. So depending on how much you want to put away into retirement will determine what you should set up. Because as you are able to put more away, it requires more paperwork with the IRS. An IRA, you just fund it once, it's done. No paperwork, no tax filings, no nothing. So that's where your combination of your accountant and financial advisor will work with you on what's best for you. And it's going to depend on how much do you see yourself putting away per year for the next few years. And you could wow, I really hit a home run this year and I need to get some tax savings. You could set up a solo K as late as November, December, and then fund it. So, let's say you had a great 2020. We're now in 2021. The only thing you really could do now is either a SEP IRA or an IRA. Those could be funded up to the due date of the return. So your second question was health savings accounts. So health savings accounts is you have to have a high deductible health plan, first of all, and then it allows you to fund that basically a savings account with pre-tax dollars. It's a smart thing to do. What I tell people do is fund it, not use it if you can, let it grow while you're still earning money. If you have the ability, pay your medical deductibles and stuff with regular money, let that health savings account grow until the point when you don't have income. So it's like another reserve. But you could put away, depending if you're single or married or family coverage, different amounts, but it's another $7,100 a year type thing that you could put away for family coverage.
Tom, I had a question coming to me. If they have an LLC, what's the process to make that into an S corp?
So you have an LLC, so you've done the hard part. You're a legal entity. to make yourself an S Corp, you have to file an election to be an S Corp by March 15th of the year. So we have 6 weeks still to get that filed if you want to be one for 2021.
Guys, also, if you're an agent and you don't have an LLC set up yet, it's actually not that hard. I've set one up for my business. I have some rentals that I keep in an LLC. So yeah, not hard.
And literally, you could set up an LLC with the state for about $90. It's like $92. That's the fee they charge. And then the other forms you could do online and be set up in a day to 2 days at most at a cost of $92. And that's it. So I'm going to give you two forms. You can write them down if you want, but it's the Articles of Organization. It's on the Indiana Secretary of State website. That's the form you got to pay a fee with when you file. And then you need what they call an SS4, SAM 4, with the IRS website. That gets you your social security number for the business. It's called your federal ID number. Those two forms in the state of Indiana, you're up and running as an LLC. You would take those forms to the bank after you got them approved and everything, and then the bank will open a bank account in your LLC's name.
Tom, we just had another question come in from Britt, and Britt, I might need to have you come off mute and elaborate, but it says, if I have an LLC for a different income stream with my husband, can I include this under it with a different DBA, or should I go S Corp? Tom, do you understand that, or do you need more clarification?
Should I get a lot? It really, so for tax purposes, it doesn't matter, right? You can either form a new LLC, put them together, you get the same deductions. Where it really matters is legal. And what I mean by that is, let's say this other business is construction and you're realtor. Well, there's different legal risks for doing the two of those. You don't want a construction accident to take down your real estate business and vice versa. You don't want your E&O claim on real estate to take down his construction business. So legally, you have to do these mesh together. Same thing people ask me all the time on rental properties. Do I put each rental in a new LLC, or can I have one LLC hold all my rentals? The more LLCs you set up, the better protected you are, but the more paperwork and costs you incur. So I flip it back, and although I'd love to do more tax returns, I'd flip it back and say, what if you have multiple rentals or multiple businesses, why not just get really good insurance policies, working with your insurance agent again, make sure those are good, get an umbrella policy, and then you don't have separate LLCs. Save yourself that extra bank account fees, all the other stuff you got to file. Did I answer that question?
She said, cool, thank you. Anyone else? Big questions for Tom. Okay. Tom, thank you.
Yep.
Guys, I just want to say I use Tom and his company for my personal taxes and my business taxes, and they have done such a fabulous job. So I can't recommend them enough. Tom, thanks for your time today.
If you need anything, you could get my contact. Just email me questions. I don't charge for questions. So if something's like, I don't want to talk in front of the group, but something is bothering you or you need an answer, just go ahead and send it. All right. Thank you, everyone.
Thanks, Tom. Bye.
Bye.